Good afternoon, this is Neil Warren, and today's session is going to look at the important issue of ensuring that your clients choose the correct VAT registration date when they join the club of the nation's favourite tax. Now, obviously, if we've got the choice of a registration date, it means we're not registering for VAT on a compulsory basis where the actual date is fixed by statute and becomes a very clear outcome. So we're looking at situations where possibly voluntary registration is involved, intending trader, to try and maximise the benefits of getting that particular date spot on in our thinking. Just to recap on the basic rules of VAT registration, the compulsory threshold occurs when taxable sales in any rolling 12-month period have exceeded 85,000. So just to recap, taxable sales include zero rated sales and those sales subject to 5% VAT, as well as those that are standard rated at 20%. And when we go over that threshold, we need to VAT register on the first day of the second month. So if we go over the threshold on the 30th of November 2016, our VAT registration date becomes the 1st of January 2017. The other compulsory situation is where at any time, so even midway through a month, we expect taxable sales in the next 30 days to exceed 85,000. So the aim of this particular part of the legislation is that it captures a large business, say an overseas business opening a shop in the UK in a retail unit, having to account for VAT from its first day of trading. So an important one to ensure there's no VAT-free period for larger businesses. I just want to recap on this issue here about payments to overseas suppliers. Now, look at the word overseas, that's EU and non-EU, being classed as taxable sales if the services in question are taxable. And the reason for this particular part of the legislation is to ensure that a UK business with, say, exempt activities, like an insurance company making sales of insurance commission, etc., does not gain a VAT advantage by using an overseas business VAT-free rather than a UK business with a 20% VAT charge, which it can't claim as input tax. So in this particular example on the slide, if you have an insurance company with all exempt sales, no taxable sales, paying an annual audit fee of £100,000, then that 100k becomes taxable sales of the insurance company. Over 85,000, they need to VAT register. And once they're VAT registered, what that means is that the £100,000 will be subject to the reverse charge on the insurance company's VAT return. So they'll account for output tax in box 1 of £20,000, but because there's an input tax block in box 4, because the activities are exempt, there is no box 4 entry, leaving a VAT payable figure of £20,000, exactly the same outcome as if the business had paid a UK auditor and not been able to claim input tax on the fee. An intending trader, now just be aware that you can VAT register a business at any time where the business owner has an intention to make taxable sales in the future. And that is not time barred with, say, a 3-year limit or a 4-year limit. It could be many years in the future. I always used to give the example when I was speaking about somebody who buys a plot of land, plants seeds to grow apple trees, and it will take 10 years before the apples will be on the trees and available to sell. Then that particular business can VAT register as an intending trader for the 10-year period until it starts selling the apples, which we zero rated anyway. So a good outcome of input tax recovery with no output tax for many years. The voluntary registration situation is very positive because a taxpayer can choose his own VAT registration date and go back retrospectively up to 4 years. Now, this is important because let's say, for example, you've got a client who would have benefited from being VAT registered, say, in 2015. He can go back, get a VAT number from 2015, get the benefits of 2 years of input tax recovery, possibly issue a VAT-only invoice to its customer for the 2-year period, who can then claim input tax, and the situation is definitely potentially a win-win, and one I'm going to focus on now with a practical example. Example 1 in my notes, and this is one I dealt with a few years ago, which had a good outcome for a number of reasons. I want to highlight with you here very much the practical side of this particular example. So we've got a guy who's a sole trader in the UK. He is a computer consultant with one customer only, a business based in Canada. Now, that income is outside the scope of VAT because the place of supply is Canada under the general B2B rules. So even if his sales were £1 million a year, way over 85,000, the threshold, that is a red herring. The actual figure, the income is outside the scope of VAT. It's not taxable, so John has no need to VAT register if he doesn't want to. John's main expense is a UK-based subcontractor doing some work for him relevant to the contracts with the Canadian customer. Now, this is a UK to UK sale, so the subcontractor invoices John, and the UK subcontractor is VAT registered, so it will charge VAT at 20% on all his fees. The fact that the UK subcontractor might go to Canada and do some work in Canada is a red herring. It's all about where the subcontractor's customer is based, which is John, and that is UK, therefore UK VAT. So what John could do is go back 4 years, so back to 2013, register for VAT on a voluntary basis, and then on his 4-year VAT return, he will claim input tax on all of his UK expenses subject to normal rules. And even better, he can look at his first date of VAT registration, let's say the 1st of August 2013, and apply the pre-registration input tax rules that applied on that particular date. So current rules are you can go back 4 years and claim input tax on assets and stock you've used in your business as long as they're still owned on the date of registration, the 1st of July, August 2013, with a 6-month window for services as well. So you can see the win here. Potentially, he might have bought a computer 8 years before where we are now, 2009, which could come within the 4 years on the pre-registration input tax, as well as all the input tax in the 4 years of registration. So a massive win-win potentially on this situation. Going back in time to 2013 would not create a late registration penalty because this registration is voluntary. There has been no compulsory registration issue, and therefore, quite logically, no registration penalty for John. Let me share with you a very interesting tribunal case which was actually won by the taxpayer against the odds, but there were some interesting circumstances to consider. So Onyx of Leicester Limited, a training business, applied to VAT register on a voluntary basis on the 1st of December 2012. Now, that was a mistake. What the guy wanted to do as a single director company was actually start charging VAT on his sales on the 1st of May 2013, which was his new financial year. So all he needed to do basically was fill in the VAT1 form and ask for a date of registration of the 1st of May 2013. Unfortunately, he didn't do that, and he created a lot of problems. The reason he applied for this VAT number 6 months ahead of schedule was because he wanted to have the VAT number in place for the 1st of May. So he thought he was actually being quite forward-thinking, getting everything sorted out ready for the 1st of May. But in fact, what he'd done was accounted for or created a liability to account for VAT from the 1st of December 2012, which HMRC identified and assessed him tax of £7,814 for the extra 6-month window. Now, Mr. Darlywell asked for that date to be amended to the 1st of May, correct the register, amended to the 1st of May, and therefore that would avoid that need for the assessment. HMRC refused. Now, my experience of HMRC, when it comes to amending VAT registration dates, they will be happy to accept if there's a typo error, on the date on the VAT1 form. So let's say you're typing away on the computer and you meant to put in 2017 and you by mistake put in 2007, and HMRC issue a certificate saying account for VAT since 2007. If you can say, oh, sorry, we made a typing error, we wanted the 2017 date, then normally they'll allow that. But if you ask for a certain date without that error and you get it, then they're normally quite adamant and say, you asked for it, you've got it, end of story, we want the VAT. Good news for Mr. Darlywell, the tribunal allowed his appeal, not necessarily because he had a justified argument, but because the tribunal judge felt that HMRC, the reviewing officer, had not done his job properly and taken into account all of the relevant factors of this particular case. And one of the key factors that the judge identified was that in this situation there was no loss of tax to HMRC with the 6-month amendment, because if Mr. Darlywell had not VAT registered from the 1st of May or had registered on the 1st of May 2013, then all of the VAT in that extra 6-month window would have been claimed as input tax by his customers. So there was no net loss of revenue to HMRC by the date issue, because all of his customers were in business and fully taxable. So it was because of the lack of the, if you like, the failure of the officer to look at all of the issues for the company that led the tribunal to say the appeal is allowed, look at the issue again, and almost certainly they'll allow this particular registration date to be amended. So a good outcome for the taxpayer. Second tribunal case is about deregistration, which I think I'll share with you here because it's quite an interesting one. Always be clear that when it comes to deregistration, you cannot backdate a deregistration date for a trading business. I get accountants ring me up and say, we've just done a set of accounts for our client, 31st of March 2017. It's now January 2018. We're doing the usual last minute rush to beat the 31st of January deadline. His turnover is below the threshold on the 17 accounts. Can we go back and deregister it retrospectively? Answer no, because you are still in the VAT club. You are still a taxable person until you actually apply to deregister from a current or future date. The only time you can backdate is if your business ceased to trade X number of months ago, and therefore you want to cancel your VAT registration date to coincide with the cessation of when you made taxable supplies. This particular company, inspired by Service Limited, scored what appears to be a big own goal by asking for VAT registration on the 1st of November 2011, but they didn't trade above the VAT threshold for many years, and they thought they didn't need to account for output tax until they exceeded that threshold. So basically, they did not submit VAT returns or account for VAT for many years, and HMRC caught up with them, issued central assessments to estimate the liability, and also default surcharges. Eventually, the business deregistered in 2014 because taxable sales were below the deregistration threshold. But 1 year later, in 2015, the company appointed a new accountant, and the new accountant asked for deregistration to be backdated to November 2011, effectively cancelling the VAT number completely, which HMRC refused to do. The tribunal supported the taxpayer. At the end of the day, the business had asked to be registered, was entitled to be registered, and had chosen that option, so could not go back and ask for it to be cancelled. So a good win for HMRC. Final point on the Inspired case. Why did they register VAT in 2011? They had mainly zero-rated purchases of food, so not much input tax to claim. Their customers are the general public who cannot claim input tax. It just seems that they made a genuine error in asking to be VAT registered. It doesn't seem to be any input tax motive on capital expenditure. And a little bit like the previous case, it's all about getting that date right, and a good advert for the need to take professional advice at an early stage to avoid lots of problems in the future. And that concludes this session.